Welcome back and happy May. So here we are ahead of the Fed, and it's time to take an important look at stocks and bonds. So today's May 2nd, 2022. Now, important reminder before we look at the charts that trading and investing can be extremely risky business. Therefore, it's your responsibility to evaluate any information, opinion, advice, or other content contained in my video. All right, so here we have a chart of the ES futures versus the US bonds. Now, why am I sharing this? So let's take a step back here, all right? So we're on the verge of a very important meeting here from the Fed. So on May 4th, they're going to be announcing very likely a rate hike, and this is expected to be 25 basis points, but now there's thoughts that it could be even higher, 50 basis points. So what I've been seeing in the markets lately, so just focusing on the top part here, is that ever since these rumors of the rate hike or possible higher rate hike have really kicked in, it seems to be a situation of sell the rumor, buy the news. Now, what I'm talking about is when a market has bad news expected. And bad news is what the stock market interprets an interest rate hike as. Because if interest rates go up, money costs more, and this slows down economic activity, which reflects in the stock market. Or if interest rates go up, then the stock market is scared that investors will flee it and go to higher yielding assets such as bonds, which is plotted down below. Now, this premise is what feeds into the whole 60-40. Have you ever spoken to a financial advisor and they recommended, especially if you're young or of a certain age, putting 60% of your money in stocks and 40% in bonds, right, as like a safe hedge? That doesn't really work anymore, and I'm going to show you here. So you can see that since March of 2020, it's no longer the case that exiting falling stocks means you're going to be entering into rising bonds. And what's happening is that actually, since then, you can see they both rose approximately the same pace and same amount of time into late December, early January. And then they both fell into February when the war in Ukraine started in late February. They both recovered into early April, but then are lower again. So 60-40 isn't going to fly anymore. That's not the way that you can proceed here. So I'm going to give you some tips on how to evaluate your portfolio going forward, given the current situation in stocks and bonds. Okay, so you're going to want to write these down. So to start with, what you want to look at is a shorter term lens for your investing. I'm not talking about like going in and scalping to trade, okay? I'm talking about going in and saying, all right, maybe I'm going to hold on to a trade for a few days, a few weeks, not just a few months or buy and hold forever, okay? You gotta have to be a little bit more conscientious of the larger moves back and forth that create the volatility. Number two, for stock selection, you're going to need to be what I call laser focused in on your picks. This means going for the strong stocks in strong sectors and at times selling the weak stocks in weak sectors all in the same period, okay? Because as volatility continues and if interest rates do go up, which seems extremely likely now, it's just a matter of how much, there are going to be stocks that love this, there's going to be stocks that hate this. And you can play both sides as long as you know what your approach is. And I do this in the Skinny on Stocks. I'm going to really go deeper with it even more, given the sort of new world we're entering here of not having rising interest rates for a few years. Number three is more than ever, you're going to have two things for your stock picks. You're going to have a target, a price level that you expect that market to rise to or fall to based on where you're entering. And you're going to have a protective stop level. So you're going to have to pick a level on the chart based on logic, and I teach this through my various courses in education, that would basically cancel out what your initial pick was and put you in a situation where you need to reevaluate, okay? So if you do these three things, then no matter what the Fed says on Wednesday, you'll be able to navigate, you'll be able to find trades, you'll be able to continue to grow your trading business. And remember that 60-40, the whole like, well, stocks aren't doing so great, so I'm going to go to bonds. It's not really flying, guys. So you need something a little bit more nuanced than that, and you need to be paying closer attention to the markets than that. I wish it was still that simple, but it's not. And like I said, we have these 3 tips I just gave you to help you navigate that. So remember to keep a close eye on the relationship between stocks and bonds. Here, I have chosen as a proxy my baby, the E-mini S&P, since I analyze it multiple times a week, usually all trading days of the week as a bonus to you guys. And it is the mini version of the large S&P 500 futures contract, which is the futures contract representing the S&P 500 stocks. Down below, the US a symbol here, that's the 30-year bond chart. And you could use a bond ETF. If you really wanted, you could also look at the 10-year bonds or the 10-year yields and compare that action. But this is the proxy I've chosen, and this is what I'm going to be monitoring. If I decide to check out any others, you'll be the first to know. So remember to subscribe, like, comment, follow, and I'll catch you next time. You can sign up with the link to get my hot, timely, actionable updates as soon as I publish right to your inbox.